Welcome back to the podcast. My name is Darson Grantham. This is a podcast around investing in real estate in the Des Moines local markets. We also talk national. I have my co-host with me, Jared Huseman. Jared, introduce yourself.
Yeah, so Jared Huseman here as always, president of the Catalyst team, KV Commercial Realty. We're multifamily specialists across the state of Iowa. Obviously, you do a lot of single-family investments, small multifamily investments in the Des Moines market. And kind of to your point, I mean, what I would say in one of my other videos is we're just here to shed a little transparency. It's always my tagline, I guess.
As much legal transparency as we can provide, we will give.
Without being attorneys or accountants, please consult your own. But we give a little bit of basically insight into really real estate, the market, economics once in a while, business.
Mindset
a little bit. We kind of shed some thoughts that hopefully ultimately benefit you guys out there watching, help you guys make money in some form of capacity or thrive as people, investors, whatever it may be. It's not always financial. It could be just better people as well.
Yeah. So in the segments today, we're going to go over, first, we're just going to go over the national news, any local news in local markets, maybe listings that we have, things we want to just share with folks that are watching. And then we're going to go through a deal analysis on some multifamily properties, commercial grade multifamily properties. And we'll do that this week. And then next segment, we will do maybe a small multifamily or rental portfolio or how to flip a house, that type of thing. So
I think going over some house flips or duplexes would be great, or house investing for your investment clients would be awesome.
Yeah, because Jared and I we work, I think of two circles, right? And we cross kind of in the middle, but really try to stay in our own lanes. Mm-hmm. They definitely cross here and there, just working with investors in general. But so that's kind of that's the segments we're going to do today.
For a real quick update from you watching for national news here, just some kind of insight into at least the apartment market for a second here, because I was doing some analysis over the weekend here. So just released my second quarter market report about a week and a half ago. We saw a little over $80 million of sales volume in the market, but we saw one transaction was $62 million of that $80 million. So we saw very, very slow sales volume. And the reason this is important, I'm bringing this up for a reason. Looking at the market today, we had over 200 million of potential sales in the market listed right now. Yet we only saw essentially 20 million, 80 million, whatever it was, sold in the last quarter. So what that tells me right now in the market is we're seeing a huge disparity between number of listings, but actual transactions are way down and slowing down for the market. So every seller in the world is saying, oh crap, we're probably coming into a recession. Maybe we should sell now, it seems like. And every buyer in the world is saying we want better deals than what you're willing to offer at that price. So looking at the apartment market, the national news, that's what I'm looking at and watching right now. And it seems to be a pretty common trend in the last 3 or 4 weeks, 6 weeks or so as well in our market.
Yep. And we're recording this Wednesday, the 13th. And so they released the consumer price index, the inflation numbers this morning, and it was 9.1%. So that has... everyone knew it was going to be around that. I think it came out a little higher than what
8.8 was the estimated.
But I mean, if you're listening to this and you're actually in the market, paying attention to real estate, paying attention to business, you know the inflation is that high and or higher. Mm-hmm. I mean, I think anyone could argue. No one can argue that. But one thing that continued conversations I have with investors is the interest rate being 6%, whatnot, right? The Fed's probably going to increase rates 75 basis points.
3/4 again,
again here shortly. And you have to be ready for that. So if you are looking at properties and you're locking in financing, pay attention to that number. But also, if you do the difference between 6 and 9%, there's still a 3% spread there. Right. And I would argue the rent prices have not increased
enough yet.
That 3% spread.
Right.
So if you do have a property and you're looking to purchase, I think you can calculate in a pretty significant rent increase in many, many cases. Now, I do not have specific data on that.
It's funny.
I just have had very few investors that I work with that have said we have had any pushback from tenants when we increase rents. They've all just said, okay. So,
and I'll echo that a little bit here. A couple of things I will say is, one, in my underwriting analysis, for most owners, generally Des Moines here, we've seen 2.5-3% rental growth annualized year over year. However, for the next 2 years, when I've been doing analysis for my clients, I've underwritten closer to 5-7% for at least the next 1 or 2 years. I see it tapering off maybe as a quote unquote this transitory inflation goes through, if that even is a real thing. But
it's a 5-year transitory.
Right. Regardless, either way, I am underwriting for my clients a higher rental increase for the next 2 years at least.
So when you say
definitely
clients,
factor that in.
buyers or sellers?
Both.
You're being transparent. Hey, sellers, you need to pay attention to this.
Yep, exactly. And the same point is back to what I say a second ago. You just kind of tied me into it. I appreciate is any seller that does this. I mentioned just now, 200 million or so on the market for listings. If you are a seller and you're watching this, look. At the end of the day, you have to make a choice. If you really want to sell, you got to get ahead of this thing. We just saw inflation come out 9.1. They estimate 8.8. We can predict 3/4 interest rate increases. Buyers are going to get even more skittish. I mean, if you think things are starting to get bad now, everybody's been saying, look, wait for 6 months, wait for 4 or 5 months. So if you are a seller, you got to get ahead of this. You got to price ahead of the market if you really want to sell. If you don't want to sell and you want to hold out for that 1031 buyer, or you just want to hold through the next cycle, completely fine, but just make that call going in and understand, are you really selling or are you just trying to get your price? And if that's the case, you may have already missed the boat.
Yep. Or just be prepared for buyers to offer what they want and
beat you up on it.
Yep. It's a numbers game.
Or be willing to wait on the market for a 1031 buyer, someone who sees the value, which it may take you a while.
That's a good point. So it could sit on the market. Like, it'd be interesting, and I don't know how you track this with commercial properties, is days on market before sale. Much, much tougher than the residential market to track. But
it's because you have to track through 20 websites to track it, right?
We've just talked about this morning. I hate it. So anyway, just something to think about too. They could sit and you could have someone that 1031's out of a different market that they aren't ready to look at Des Moines until 6 months from now, and you list your property and it's high, but it's not outrageous, and you might find that person in 6 months. You never know.
Yep. So anyway, tying into our deals here a little bit. So do you want to talk about what you pulled the first?
So the reason I want to do this is I enjoy listening to someone else analyze a deal. I realized that last night. I had beers with some syndicators from California. They came into town, and I grilled them on, why'd you pick Des Moines? How do you analyze a deal? What do I need to know? What am I missing? Blah, blah, blah. Because my experience with helping buyers and syndicators try to find deals is they all kind of calculate things a little differently, or a lot differently. And so I've really struggled with me analyzing properties and saying, this is something that you should consider, right? And quite frankly, I don't have a vast experience underwriting larger deals. So wanted to get you in here, question you on how you analyze deals. So we pulled up a 16 unit and an 8 unit. So nothing massive. I mean, these are in the range of my clients that are looking to upgrade. Probably some of your smaller clients, smaller clients that are maybe in that mix. So,
but the ratios, and we'll go into this here too, but the ratios, not as accurate for an 8-plex, but for 16, 24, 48, 100 units, the ratios do remain the same. Ironically, the ratios I will talk about here in a second. They're quick and dirtier ratios. They're not perfect.
Right. And that's
you need to be able to do these ratios quickly so you can analyze something and move on to the next and be able to say yes or no on a smell test.
Yep. And so those of you that are listening on a podcast, I apologize. We are going to go through actual sheets and talk about properties. We'll do as much verbal explanation as we can, but the numbers are going to be kind of a lot of it's going to go real quick for you. So if you want to see the numbers and see how we're analyzing it, go to the YouTube channel and look at the video that we're posting here on that. So first we'll start with the 8-plex. It's 8-plex.
Hold up here.
Yep. And quite frankly, we'll pull this up on the screen. I don't know if this is still active. It was active. I mean, it was on Craigslist where I pulled it from. Quite frankly, the property that we're actually looking at, it could be something that I pulled 8 months ago. It's not the point that we're looking at this specific property. It's just how, when we each look at properties, what we think, how we think, what we look at. So it's an 8-plex. This one's at 910 Harold Avenue, $65,000 a unit, which the fact that it's an even $65,000 a unit makes me laugh. Because it doesn't come out that even very often, right?
Well, I mean,
how do you find the price?
I can say a couple of different things already here. I know all these deals. I've seen them all. I watch them all. So first off, 910 Harold Avenue, Des Moines. It's listed through SVN, the Shared Value Network, also known as Sperry Van Ness. Heath Bullock and his team over there is who has listing. Great guys. It's been listed now for 78 days. First thing I can look at is this is 50315 zip code. So we're talking the southwest side of Des Moines.
Hey, I grew up there for 10 years.
Right out
of college.
Yep, this is on 9th Avenue here, or 9th Street here.
Yep. So
know exactly where it's at. I don't know the unit mix. I don't know if it says it here or not. But we're going to break this down here quick. So let's see what we have here. A lot of different overlays. Can't see it here.
I don't think
anyway,
either.
$520,000 is the list price, by the way. So $65,000 per unit. It's listed as a value-add C-class building, 4,708 square feet, priced at $110.45 per square foot, 6.6% cap rate, occupancy 100%. It's saying a net operating income of $34,708. Again, 8 units, built in 1975. One building, 2 stories, zone MX1 on 0.36 acres. Again, as I said, $65,000 per unit here. So it says here we have actually 8 one-bedroom units here. So first thing I can say off the bat here, and I just know the market wants to know, a one-bedroom apartment unit on the southwest side of Des Moines like that is going to rent for probably $725, $745
Yep, I was gonna say 700 to
per
800.
month.
Yep.
Depending on how nice it is, you'll get 800 if you're into the really nice. Depends on the size of the unit, square footage as well. Here's what I'm looking at right now, 4,708 square feet. So if we take that, you're going to lose usually 10% of that to area of common areas. Yep.
Okay.
So 4,708 times 0.9, that's 4,237 square feet divided by 8. We can estimate a 530 square foot unit for the one bed. Okay. So now we're looking at 725 as a, let's say, average rent divided by 530, which is about $1.36, $1.38 per square foot in rent. Depending on utility structure, that's going to be probably in line with the market.
Yep.
Generally speaking, our market is about 110 to 120 per square foot.
Isn't that really tough
rental
to
rate?
like to broad stroke that?
It's
When you
tough broad
have-
stroke.
Like this is for sure C class. It's
Yep.
not. It's going to take a lot to get to a B, especially
In that area.
right, in that area. But your B's and A, I mean, I don't know.
Yeah, it all depends
so
on the
hard.
amenities
It
and it
is.
depends
It
on so
is.
many things. And then utility structure, especially on older properties, boiler system, heat, etc. But we're broad stroking this here for everybody watching. Anyway, 725, 745, probably the average rent. We're going to do conservative numbers here because we want to be conservative, which all buyers I've ever talked to are always conservative. I've never met an aggressive one in the world because they always want to see value against the value add. So let's say we take 725 per unit times 8. That brings us to $5,800 per month of gross potential income. That's GPI. You'll see this a lot in apartments, GPI. Gross potential income. So gross potential income per month, $5,800. We'll take that on an annual basis times 12. Puts us to $69,600 annual basis per rent. Now, they're stating that the NOI is $34,708. So first thing I'm going to do is take $34,708 divided by $69,600. And what I'm trying to see here is how much income are they saying they think they have divided by that number here. So what did I say? 725 times 8 times 12 is 69,600. So 34,708 divided by 69,600 means their income is about 49% of their net income is 49% of their gross potential income.
Right.
So this actually looks in line. Most
Right.
properties I've run that are 1960s and 1970s vintage, I want to run a 50% expense to income ratio. So that means half your expenses are going to go towards taxes,
Yep.
insurance, utilities, maintenance, capital reserves, management, that kind of thing. So I can say right now this NOI looks pretty accurate based on what they're showcasing here. So the NOI looks good actually. It's in line. So 34,708. Again, that's a quick dirty number divided by that 520,000 does put us at the 6.67% cap rate. So this deal looks like it's actually been marketing correctly. That's the first thing I can say.
The pro forma is not too bad.
It's actually
At a 6.6,
at a
right?
6.6 cap
If
rate.
you believe that property in that area should be a 6.6.
Right, and it should. And now all you do is just figure out what your debt's going to be, and you'll figure out your debt payments, and you'll take your 34,708 minus your debt, and that'll create your net cash flow, your cash on cash. So again, as we're doing this out loud, if you're watching, you're going to have your gross income minus your expenses, your net income minus your bank charges to have your net.
Yep.
You know, that's why we call your net, and your net per month annualized divided by your down payment is your cash on cash return. So that's how I'm doing it here.
Because you've already taken out the CapEx.
Yeah.
I mean, because that was the 50%.
50%.
Right?
Yep.
Okay.
Yep. So what I'm going to do a quick rule of thumb for anybody watching here is take your GPI, your gross potential income, anything that is 60s and 70s product type. This is just a broad stroke number. As long as it's accurate. 50% expenses, 50% profit before your bank. If you're 80s, 90s product vintage, you're probably in that 45%, 47% ratio. A little bit newer, so you don't always have all the CapEx repairs. Not always the case though. Sometimes you'll actually have new furnaces and AC units, which actually cost more than a boiler system heat,
Right.
ironically. If you get in the 90s, 2000s, you're starting to run at that 45 to 43% expense ratio. Anything built after 2000, usually 40% expense to income ratio, and then brand new about 35, 37%. So the percentages of expenses to income tend to go down the newer the product type, and then obviously the older, the more they go up. If you're looking at 1900 product type, that's old, 65% expense to income.
Could be. Yep.
Could be depending on the product type. So this property looks like it's being accurately marketed. I think 6.6% cap rate at the time that's being listed might have been an okay deal. I think it's a little bit high priced for one bedrooms in that area.
Because of the cap, like the cap being that high, or what do you, when you say it's high priced?
It's
does
high
that mean
priced.
You shouldn't use that cap rate.
It's high priced, in my opinion, it's high priced today because the 6.6 cap rate based on today's borrowing rates aren't going to work. Most investors are going to want a 1.5 to 2 point spread.
Gotcha.
I think this property, when it went to market, was probably accurately priced.
Which was 43 days
If
ago.
it was 78 days ago, actually.
78. Okay.
Yeah, so if it was 3 months ago, it probably was pretty accurately priced at that time for what debt was doing at that point.
Gotcha.
Today's valuation, I'm just ballparking it, and I know the market because I had another 8plex looked at just this week. I ballparked it was about 490,000.
Okay.
So they're probably 30,000, 35,000 overpriced, which if we do the math on that, 35,000 divided by the 520 is probably about 6% overpriced from what it's at today, 6%,
Gotcha.
which is pretty common. I've been seeing most buyers want to offer anywhere from 3 to 5% off whatever the price was listed at. So overall, though, I mean, a good property. Southwest 9th Street's a good area for the most part.
But you
Very
got
solid
all the
C.
eyeballs in the world with Southwest 9th, a lot of traffic.
Yep, very solid C. Never going to be a B or A, probably.
Yeah.
But overall, it's being accurately marketed. I think this is a good property. Again, it fits all the smell points, or smell tests, I should say. It's just a matter of what your debt can be on it.
Yeah, I mean, I think that pretty much wraps up what I wanted, like how I wanted to talk through this. So now we'll switch over and we'll do a little bit bigger unit, double that size. We'll do a 16 unit up on Hickman, and I'll let Jared kind of talk through that one.
Okay, so this one actually had a client make an offer on as well. We weren't able to come to price on it, but I know it very well. 5902 Hickman Road, Des Moines, Iowa. This is over in the almost Urbandale market. It's not quite there. It's right on the fringe. 1.15 million. It's called the Hickman Apartments. 16 units, 2 8plexes. Listed by CBRE. My friends over there, Cy Fox and Ray Hamilton. Good guys. They do a lot of multifamily. Very usually good at their job. So listed for 1.15. It's listed as a B class unit. So here's the thing I want to notice right away. Listed as B, and it was built in 1967. However, the last property, 910 Harris, was listed as a C class property built in 1975.
Yeah.
So notice the difference there. Different vintages. They're literally different by almost 8 years. This project right here is 8 years older than the last one, but it's listed as B class and not C class. Now that is partially the area, but you need to take into account the difference in marketing right there and just looking into that.
And I mean, I know that there's a spot on Crexy for the class. I find it hard to believe that anyone takes that and actually makes a determination off of it. Right. I mean, if you're going to filter for all B class properties, you're probably going to do C2 because of the overlay.
The overlay.
So, I mean,
so this goes back to what I'll say is that the classification of A, B, and C is very subjective. Very subjective. Actually, if you follow it enough, Des Moines has not a single A class property in our entire market. If you compare it to what they call A class in New York.
yeah.
We actually have no A-class properties at all in the entire Des Moines. Matter if they're built brand new. Anyway, moving forward, 2 stories, again, 2 8plexes. Again, value add, shocking. 16 units, 2 buildings, $71,875 per unit. I do know, without seeing all the numbers on this, that this property does sit on a very nice corner lot. Has plenty of grass here, very good visibility.
Yeah.
It's in a good area. Roofs are a bit older. It's boiler system heat. Should be 2-bed, 1 bath.
All are 2-bed, 1 bath. 50% of them are recently renovated.
Yep. There was a fire in this project. I know that.
Ooh.
That actually caused some of the renovation of the exterior balconies and some of the units. But the windows are older boiler system heat, older roof. I know this from reading this and also being involved in this deal, making offers on it. But a 2-bed, 1 bath in this area, depending on the square footage of the building, is going to be probably right around $795, $805 per month in rent.
You don't think you get $850?
$850 is going to be a stretch. $825 maybe, depending on the classification if you fix it up as well. I think $825 if you can get it really really well fixed. But I think $850 would be a stretch.
Is that due to the location or the property? Or I mean, it's obviously it's always both.
It's due to location. That at the end of the day, you're still going to share. You're still going to be sharing with someone else a hallway. You have outdoor parking with no garage, no attached. It's a great area. I think could you get 850 in a year or two? Absolutely, but will it be a stretch today? I think you're going to see some vacancy. And this goes back to a point where you're making actually is how much are you willing to accept vacancy? I think 850 could be doable, but understand you're going to probably have always one unit vacant.
I'm just thinking of what other options are you going to get at 850 in 2-bedroom?
So
like in that area, I just think I personally, and this is no statistic, I have no data around this, but the opportunity in a lot of these properties is to bump rents, renovate, make them a little bit nicer. Because we're going to show pictures of these, and like they don't look like they were done renovated past 1992.
And these were built in 1967, so probably haven't been updated in 30, 40 years.
But 50% of them have been renovated.
Right.
In the pictures I'm seeing on Crexy, if that's renovated, we have different levels of renovation. You know what I mean? Like I get, if it's just carpet and paint. But these are like a lot of old oak, a lot of, like the bathrooms does not cost very much to get a little bit more style in a bathroom.
Right.
So, yeah, maybe I'm crazy. Maybe I'm not the normal, commercial property owner. But
let's run numbers on this then. So let's pull up the calculator here. Let's say this is getting $850 a month in rent. Let's just be a little more aggressive here on this one. Last time we were concerned, let's be aggressive this time. We'll see what comes up with. So $850 a month times 16 gives us a gross potential income monthly of $13,600 times 12 gives us a gross potential annually of $163,200. We don't have any expenses or NOI listed here, so we're just going to do.
I like your 50%.
Well, I was going to say it's actually 47% because here's why. One of the buildings has been upgraded supposedly.
Okay.
And so we're going to run one building at 45, another building at 50. We're going to meet in the middle at 47 on average. So
the one good thing about a fire, especially in Des Moines proper, is the city's very, very picky about getting permits to fix it correctly in most cases. So when you have a fire, the city's on that, like white on rice.
Right.
And so they probably did renovate up to city code standards, which is a big plus.
Right. So let's say we're at 52.5% net income to your gross potential income. That's annual $85,680 annually divided by your $1,150,000 puts you at a cap rate of 7.45.
Okay.
Now, what I can say on this building is that actually sounds pretty good. This building does need capital improvements, though.
Yep. That's what I was going to say. The roofs are what? If you said the roofs are older, that's one bothersome for me.
And boilers are old. So I think this building is probably worth 1.15 with new roofs and with new boiler systems. I think you guys need to make a calculation on what that's going to cost for you.
Right.
Generally speaking, I like to say at minimum $10,000 per roof and at least $10,000 per boiler. So you're looking at about $40,000-$50,000 of capital improvements. With inflation, you might want to be a little bit extra on top of that, maybe say 60, 70, just because labor costs are hard to have right now.
Yep. And to hit that 850, you need to do more than what has been
what's
done.
Standard.
Yeah, right. More than in each unit the 1992 upgrade renovation.
So, and let's pull some numbers again. So we said $850 per month rent out of those, and that puts us at, again, a 47.5% expense, 52.5% income. That's a 7.5 cap. Let's do numbers here. 825 times 16 brings us to 13,200 monthly gross times 12, 158,400, and let's do the same 52.5% expense ratio, or income to expense, and 47.5% expenses times 52.5. Whoops, wrong numbers there. Please hold. Oops, 825 times 16 times 12 times 0.525. That brings us to $83,160 NOI annually. On that $1,150,000, that puts us to a 7.23% cap rate. Right. So the reason I'm saying this is, look at that. At 825 to 7.23, at 850 to 7.45 or 49. So we have a quarter point difference just in $25 per month. This is why it's so important for owners, by the way. If you are actually running your numbers and raising your rent, it's so important. You might not think $20 per month per unit means much, but you need to look at what that means for the value of that property. Because at $850 a month, this property is worth $1,150,000 minus any capex improvements. At $825, I would say it's worth about $1.1 million minus any capex improvements. Right. So it all depends on how aggressive you want to be in your underwriting.
Do you think a cap rate of 7.72 is adequate for that area?
For this area, what we're seeing right now in our market is, generally speaking, high sixes, low sevens.
That's what I was thinking. So if you ran that with that rent coming in at a 7 cap, it's probably 1.25.
Right.
You know what I mean?
Yep. Minus any capital improvements.
Right. Minus capital expenses. Yeah.
So again, both these properties are on the market. They're both, really close to asking price. I mean, if we made an assumption here at $1,100,000, it's only $50,000 off price. You're only about 3 to 4% difference.
Yep.
So at the end of the day, both are running the similar kind of expense to income ratios. Both are good properties.
They're pretty similar properties. They aren't drastically different.
Very similar. And the thing about Iowa is in Des Moines that we have a lot of product type like this.
Yeah.
That's why it's really easy. This is why myself and certain buyers I work with and owners actually judge their entire buying process not even off cap rate. They judge it more off style of units and price per unit. Because they know that every apartment complex is, if it's a 2-bed, here's your rent, here's your price per unit. It's a 1-bed, here's your price per unit, here's your rent. Because they know how expensive they're going to be because we have a very similar product type. It's one thing goes back to, it's an old school method not used very often, but we could almost use GRM in this case, the gross rent multiplier. It's an old school antiquated system, but it almost works. It only works if you have similar product styles.
Yeah, it's old school and small town.
An old school small town, but it actually does work for some of these product types actually anymore, especially when you know what you're doing. So again, I have certain clients who buy on price per unit only just because they know the market. And again, these are both very similar.
Cool. Well, I appreciate it. I mean, it's fun to run down these properties, just do a quick evaluation. Thanks for sharing and giving your insider information and knowledge.
Right.
So if anyone has any questions on these properties or any other commercial listings listed, reach out to him, pick his brain about him. He obviously does this stuff every day, all day long. I am just learning, but gosh, there's so many of my clients that have bought single families since I started or before I started as an agent, and they're like, hey, we want to start looking at 8, 10, 12, 15, 20 units. And so I've found myself more and more looking at them, trying to figure out how do I, just make sure I know enough to be dangerous, bring Jared in and where needed. So
right. Well, all I can say too from experience here, one reason I'm good at analyzing properties like this is not only is this my job and I do this every day, but I've owned properties like this. Yeah. I've owned a lot of property like this, and I've looked at a lot of properties over the years. I've even, made offers on a lot of these product types when they were back foreclosed down in 2010, 11.
Should have bought them all.
I know, should have bought them all. But it's like Pokemon, I got to catch them all, I got to buy them all instead. But anyway, the reason I say this is that I can look at most pro formas or most actuals, either way, and very, very quickly judge what's out of line, what's out of whack. You give me an expense report, and I can usually tell you if your heat, if your water, electric, taxes, insurance, lawn care, snow, if it's in line or if it's out of line, because I just know. And generally speaking, I know because I used to own stuff. I know, an average.
Well, it goes down to you just have thousands of conversations and you look at a lot of properties, and we talk about this all the time. Des Moines is a very small market. If you're a new investor and you're looking at Des Moines market, I talked to the guys last night, the syndicators, and I'm like, listen, and Jared stopped me this. There's about 50 to 100 people that actually know multifamily markets in Des Moines. I mean, whether it's owners or brokers, there's a total of about 50 to 100.
Well, it's funny because last night, as you said, some of the people that were sitting around the table and there, I knew at least 2 or 3 of them. Without, I said, oh, it's this person and that person. I didn't even know who was all there. You said this was what company they were with.
That's what he looked like.
and I could tell you exactly who it was. So that's the thing. It's in any market really. That's interesting that eagles fly with other eagles. I will say that in kind of a weird way, and you're going to see less and less pigeons at the higher levels. So we start playing at the house level. You might have a lot of people with you. You start playing in the multifamily world, development world, 10, 20, $30 million projects, $100 million projects, depending where you're at. Look, it gets smaller and smaller very quickly.
Yep. Which is a good and a bad thing. So yeah, if you are evaluating markets, do your due diligence. As you know this, I don't have to tell you that. Yeah. So cool. Okay, we'll wrap this up. Jared, what do you have going on? What do you want to share with everyone before we end this?
What do I want to share? Biggest thing I can say to anybody is just, kind of back to what we were talking about earlier a little bit. Is anybody out there watching? At the end of the day, all I care about is you guys have the best knowledge for yourselves. Whether it be this product type, we say intellectual deals here as well. But when you're working with professionals, make sure you're working with true professionals. I don't care whether that's your CPA or your attorney or your agent. Make sure they're actually being professional. I talked to a gentleman yesterday. He's trying to list his apartment complex for sale. This is a 8-figure deal, and he said he couldn't get calls back from his agent. And I asked him why was he even listing with them, and he kind of said, well, because they have a reputation of doing big deals. But that was it. He had no reason. And in my opinion, if you're getting that kind of service on an 8-figure style deal with over a 6-figure commission check, you should ask yourself why you're paying for that. So the point I'm making this is that make sure you're working with professionals in all assets. Anybody can come out there and sell you an investment house like Darson. Any agent in the world will tell you how they work with investors, and they work with investors to sell houses. And the common theme is, you know, anybody looking to buy, sell, or invest. I hate that term. Not every agent knows investors, knows how investors work. So for my advice to anybody out there watching is make sure you find, to your point, one of those top 50 people who are actually doing the real business.
Yep. No, that's good. And I will piggyback on that and just share something. I was talking with a group around the table last night, and they said, you know, we've looked at a lot of markets, and I always grow them. Why Des Moines, right? And they said, well, the network, the market in Des Moines is a tertiary market, right?
Market, yep.
And I said, is it a tertiary? Is it a tertiary, right? Like where levels? And we kind of went back and forth and laughed about that. But they said the numbers of Des Moines, if you overlay 2010 to 2020, they're pretty similar to your Scottsdale, Arizona, your quite frankly, they're like Dallas and Austin, same thing. It's actually a pretty just straight line up of population growth, all of that. But if you go back before 2000, I think it was 2010, Des Moines was very flat. It was very just status quo. And so the growth and the exponential growth that Des Moines has, that's where they see the opportunity in Des Moines. And so whether you are buying in Des Moines, you're buying in Nashville, you're buying in Dallas, their comment on Des Moines was that when you buy property, you're buying the market, not the property. And that's where you make money.
Yep.
Yes, it's a property. Yes, you have to underwrite the property. Any Joe Schmo can do that. But can you analyze and guess, for lack of better terms, what the market is going to do? And how do you do that?
You know, this could be a whole other subject point here, Darson, but I love what you just said there, is that, like what we just did here with analyzing deals. At the end of the day, that's actually pretty easy. That is actually something that you can learn it, you can do a scale set, you can choose the numbers I just gave you, and for most part get quick and dirty analysis on properties. So I would say, I'm making a weird analogy here, but you know,
of course you are.
This would be college sports level, is learning how to analyze properties. The professional sports guys are the ones who analyze markets.
Yeah.
If you want to be professional, learn how to analyze markets, not just properties.
Or this reminds me of, and we've talked about this, the Starbucks thing. Or just go buy near a Starbucks, right? Buy a house near a Starbucks, because you know they've done the research.
This is what Grant Cardone does. Grant Cardone says,
really?
Grant Cardone said,
maybe that's where I heard it.
Grant Cardone always says, he goes, I don't analyze a market. He goes, I just go literally buy next to Target, buy next to Starbucks, buy next to McDonald's, because they spend millions of dollars a year to have the best data, have the best resources. So
cool. Okay.
But that's more local. But I'm still saying, like, analyzing the Des Moines Central Area Marketplace as a whole, learning how to do that. By the way, if you want, CCIM 102, phenomenal.
Time out. What did you say again?
Phenomenal class. CCIM 102. Okay. It's a class. It's going to cost you about $2,000. It's a 5-day course on how to analyze markets. Phenomenal. You start learning about NIAC scores, how to look at job growth. Because jobs
they show you the website and how to do it?
Absolutely. They show you to look at NIAC scores, find industries that are growing, so you can actually analyze industries, which are growing the fastest. By the way, construction in Des Moines has been growing faster than any other industry in the last 12 years.
In Des Moines.
In Des Moines. Fast industry growth is construction for us.
I love that. I just don't want to do the research, Jared.
I know, but
I want someone to tell me.
Someone else teach you how to do it.
No, I don't need to. I don't want to know how to do it. I just want to know what the results are of Des Moines.
Right. So anyway, but again, back to what we were saying is, if you want to be professional, a semi-pro can analyze deals. A professional can analyze markets, and then a true star can do both at the exact same time.
Yeah. Cool. So, okay, we'll wrap this up. Appreciate you guys watching, listening. If you have any questions, reach out to us. We are here to help, just have a conversation and educate you about the Des Moines market, real estate, and all that good stuff. So,
sounds good, guys. All right, take care.